I'm Charlotte McLeod with investingnews.com, and here today with me is private investor Don Hansen, who I know our audience will remember from our many previous interviews. Really good to have you here today. Thanks for being here.
Thank you, Charlotte. I am excited to be here today and have a chance to talk with you and your audience again.
Yes, I think we're both excited for what we're going to go through today. It's always great to talk to you, but especially when there's so many things going on in the gold market. So you have quite a bit of new information to share with everybody. And one of the points that you're building toward is this idea that we're in kind of a holy grail situation for gold. So we've got some slides to look at there. You've got a number of points to go through. So let's kick it off there.
Okay. Yeah, I use the term holy grail because what I've become aware of is that there is a very special combination of circumstances that's developing that's extraordinary, that's never happened before, and all of the circumstances are pushing the gold price up. And so I wanted to go through that. As you know, I've been doing research on the gold price and the different parameters that affect it over time, and we've talked about them. And the curious thing is recently I began to see something in those relationships that I didn't realize until now. And that's what I'm excited to talk about. But the first thing I think we should do is to talk about the three most important parameters that affect the gold price. Okay. And the three parameters are the U.S. money supply, the U.S. stock market, and the central bank buying and selling of gold. So first, let's bring up slide number 1A, which shows the relationship between the money supply and the gold price. And you can see there that while the gold price and the money supply are tracking together, there have been points in time, as like in 2013, where that was the high point of the previous gold bull market between 2000 and 2013. And then the gold price dropped down below the curve. And what I'm showing at the end there is in 2030, where we would see if the gold price tracked the growth of the money supply, where the gold price might be in 2030. So just to give you sort of a general idea. One of the things also that I learned in studying the money supply was that from 1995 until 2025 now, that number has compounded 35% on average every 5 years. And I just stumbled on that because I've been using 5-year time frames for these graphs. But the odd thing is that the average has been 35% over each 5-year period, but it's been relatively constant through that whole 30-year period. The highest was 40% over the most recent 5-year period, and the lowest, I think, was 31 or something. So a fairly tight range, which tells me that that's not an accident, that there's some kind of intelligent design going on there, and the designer is probably the Federal Reserve. But I never knew that, or that they were making an effort to actually control that growth that close over that long a time. I think that probably started, if it was 95, would have been in the early Alan Greenspan years. And as you'll recall, he was somewhat of a gold person. It was an Ayn Rand acolyte and all that back in the 60s and 70s. And I think had an idea that he was going to try to have a stable money growth as if it would be like gold. Of course, only a lot more than that, but I don't know what is causing that number to be what it is. And I've just recently realized it, but I'm very curious to understand it more. It's like the more I learn how much I don't know. Maybe I have encountered that experience.
Yes.
So anyhow, let's see what else I was going to say about that. Oh, the other one, why don't we go to the next slide, just for reference, slide number 2. The other thing, of course, that I learned over time, you can see the date is last year in July, but the pattern is very obvious in that the curve of the money supply and the debt track each other perfectly. So I assume that maybe it's the debt that's actually the independent variable there, and that the Fed is just controlling the money supply to make sure that the debt gets covered. That I don't know, but I don't have anybody explaining why they're so perfectly correlated, but they are. And of course, because of the debt to GDP ratio that's grown so much, and we'll go to the next slide, number 7, where we can see that the debt to GDP ratio is steadily going up as everything else is in terms of this exponential rate. And when it gets over 100%, that's generally regarded as a danger zone. And one of the reasons primarily is that you get a situation where the interest expense on the debt becomes very difficult to maintain. And we're already now seeing that as you can see the debt to GDP ratio now in 2025 is about 125% already. And of course, as that gets ever greater, then the interest expense gets ever greater. And you're going to have a situation where the Fed is ultimately, I think, going to have to print money or go into the quantitative easing mode again in order to help the federal government pay its bills. And that, of course, will be inflationary, and that will help the gold price even more, I expect, as time goes on. The other thing that I wanted to point out that's curious about the money supply growth being 35% on average, the greatest growth in that whole sequence was in the 2020 to 2025 data, and that's data is all January 1st, so that it has 2025 in it. But of that 40% for that 5-year period, all of it happened in the first 2 years, and there was no money supply growth in the last 3. So it's like you could see, oh, okay, they didn't let it grow anymore because they wanted that 5-year period to be like the others. But that also means that all that money that got spent that stimulated the economy in the United States in 2022, 3, 4, that all got pumped in there during the COVID years. And now that's pretty much been absorbed. And so now we're in a new mode again. So I thought that was curious, and I didn't know that until I looked at the data and began to see, oh, okay, there actually was something unusual about this last 5-year period. But
Yes.
anyhow, okay. So then the next part I wanted to talk about is, let's look at slide number 5, which is the U.S. stock market against the gold price. And as you can see, the gold price with the circles, that it was up in relation to the stock market in particular periods. Like in 1980, you can see the circles, it was above, and then again in 2012, whereas below the other. So I basically tried to discover patterns. And what I discovered is what you can see down in the lower left-hand corner, where, and all this data is mid-year now, and you can see where in that first period in the 70s, that gold was in a bull market, and the S&P was stagnant or in what you probably consider to be a bear market. And then in the 1980 to 2000, gold did badly and was down by half, whereas the S&P was down enormously. But of course, part of the reason it was down up so much is that the stock prices in 1980 were extremely low. It was one of those periods. I think the famous Business Week article on the front page was that the stock market is is dead kind of thing. You knew it was at the absolute bottom, and nobody wants them anymore. Then you had a reversal, and again, the decade or so, 2000 to 2012, gold's in a bull market, S&P's in a bear market. Then we had a flip again, going back. Gold's now only just stagnant, and the S&P, as we know, is up substantially. So obviously there's a powerful inverse correlation. So we can say that the condition of the stock market is impacting the gold price, because obviously they're backwards. And the logic of that is that if the stock market is doing poorly, then the investors are looking someplace else to invest their money. And gold is where they tend to go. And it's a safe haven, considered been for thousands of years. And so that's why you see this back and forth happening. Then the other parameter, the third one, is the central bank buying. And let's look at slide number 4 again. And you see, I've shown this one before, but it's really amazing to see the enormous shift that occurred in 2010, where you had a whole lot of selling. And I could not find any data prior to about 1992 on the selling. But it made this enormous shift right there around the so-called great financial crisis problem, and where the world central banks began to take a different attitude towards the US dollars treasuries, to the point where in 2015 or 2014, the dollar value of US treasuries held by central banks stopped rising. And in 2024, it was the same amount as it was in 2014, because they were using the money that the US was paying people to buy all the things we imported with dollars, and then using the dollars to buy gold instead of treasuries. And so that's the key pivot that happened there. Something else that I thought was interesting, if you go back to the previous slide number 5 for a sec, notice that in the first gold bear market from 1980 to 2000, gold was way down, okay? And during that period, the central banks were selling all the way through it. Whereas then when you go to the bear market period for gold in 2012 to 2021, it wasn't down at all. It was just up a little bit, but realize that that period was where the central banks were buying. So you can see the impact that the central bank buying versus selling had on what gold did during its down period there. So I thought was interesting to look at. The other thing that I thought was curious to note in the buying and selling gold thing is that the gold buying went up astronomically in 2022. And so 2022, 23, 24, all 3 of those years, the gold buying was over 1,000 tons a year, which was twice what it had been on average prior to that. And so but the gold price didn't do very much until the fourth quarter of 2023. And that's when it took off. And the interesting thing is that now we see we're in a gold bull market right now, and yet the stock market hasn't gone down. In the previous cycle, in 2000 to 2012, the stock market went and crashed between 2000 2001. The NASDAQ was down 80% by 2002. The gold price didn't do anything until like 2003 or 4, and then it took off. This time, the gold price started going up, but the stock market hasn't even gone down yet. And that's what I'm talking about, and that's so interesting to me, is that we have the money supply pushing the gold price up over time, and that's pretty much of a constant. And now we've got the gold buying by central banks at a very, very high level, but the stock market hasn't gone down yet. When it does, that will be the third of the three big fellas that pushes the gold price up. And that's what's unique that I want to talk about today, because this is the first time in history that you're going to see where all the cherries have lined up and the slot machine's about to pay you off because you've got all three of those as tailwinds to gold. That's the holy grail. It's in a situation that is all everything acting towards pushing the gold price up, and yet I don't hear anybody talking about that. Gee, that's really special. Well, it really is special. And when it does happen, where the stock market goes into decline, you're going to see an enormous amount of money come into the gold market, because the stock market is so overvalued now by every metric. The Shiller PE ratio is 35. On average, it's been 17. The Buffett indicator that is so popular because Warren was the greatest investor in my lifetime, and that was that the aggregate of the stock market's capitalization divided by the GDP of the U.S. is what he looks at. In other words, the stock market shouldn't be growing a whole lot more than the economy. Well, it's at an all-time high now, which is why Berkshire Hathaway has $360 billion worth of cash equivalents, because Mr. Buffett's the indicator says this isn't going to work. And the other thing about this is the vulnerability of the U.S. stock market is very dramatic. The reason is that so much of the money that has come into the U.S. stock market in the last 12 or 15 years has been stock buybacks. It's huge, and it's still large. For example, in the first 4 months of this year, the stock buyback money was $660 billion in only 4 months. Well, you can say, well, that doesn't make sense, but why are the buybacks happening? All of the managements, all of and insiders in the corporations, they get bonuses based on the share price. So they don't care if they borrow money and indebt the company if they use it to buy the stock back and goose up the share price. And they've been doing that for a long time. And of course, they could also, back in the Bernanke era, when we had 0% interest rates, the big corporations could borrow for almost nothing, for free money, and buy back the shares and goose up the stock price. Well, this is a totally unsustainable pattern, but it's been going on for a long time. But what happens all of a sudden? We have a recession and the corporate profits go down and the interest rate's too high for them to borrow cheaply. The buyback money's not going to be there anymore. And you have a very, very high percentage of the stocks in the United States that are owned by foreigners, a record high, like 18 or 20% of the value is owned by foreigners. And that has happened because the U.S. stock market over the last 10, 12 years was doing much better than the markets in Europe or Japan or China or whatever. So they were putting their money here. But if it starts to go in the other direction, they're going to take their money out. And all that money is going to come out from the foreigners, and no more stock buybacks. And where's it going to go? It's going to go to gold like it always does. And that we haven't even seen that start yet. And already we're in a gold bull market. So that's why I'm saying this is really a holy grail moment, where the legend of the Holy Grail is you drink from it and you get eternal life. Well, we're not going to get eternal life, but we're going to get one hell of a gold bull market. That's what I see coming. And that's why I'm so excited.
Yeah, I think we can really see the case lining up for gold if we didn't already. We've got not one, not two, but three factors all converging to push the price higher. Great to get your thoughts there. We also want to take a look over at what's happening with the gold stocks. You do a lot of analysis, and we'll take a look at what's going on with your favorite gold stocks, as well as some of the major players in the sector. I know that you really advocate looking at specific companies instead of taking that across the board approach of something like a GDX. So let's take a look at the gold stocks.
So the next thing we want to talk about is the data sheets, and that is slide number 8. We can look at that one. Okay. Yeah. And one of the things that I wanted to talk about, if you look at the numbers there, and you can see, okay, the gold price was up 70% in 18 months. I mean, that's unheard of to see
Yeah.
it did that much. Silver, not quite as much. The share price of the companies that I like is K92, G Mining, Rio 2, Medium, and Calibre all went up. GD Mining is relatively new, and you'll see in the next chart that they actually went up 100% in the previous 6 months. So very good company. But then you look at the Kinross, Alamos, and Agnico Eagle, Newmont, Barrick. I wanted to put those in there to give people a sense of what's the rest of the market doing. And I'll talk about why I don't necessarily favor investing in them. And then, of course, I got the royalty companies there. And then the Dow and the S&P, the NASDAQ, and below, where you can see that the stock market is not in a bear market yet overall.
Yes.
But if we go, the next slide will be just the last 6 months, and you'll see where the stock market has actually already started to head downwards. But something that I want to point out, let's go back to the first slide number 8 again. Something that I want to point out that is also significant is that if you look at the gold price there and how much it went up, and then you look at how much the profits of the gold miners went up, it's a very different number. The way I calculated it is that assuming a all-in sustaining cost of $1,400 an ounce, that you go from say 32, approximately 3,200 minus 1,400 is an $1,800 gross margin. And if you look at where we were at the beginning, is roughly $1,900. So that's a $500 gross margin. So the increase in the gross margin in that 18 months was 3.6 times, or 260%. And yet, what we see in the mining shares is that they're at best maybe 2 times the gold price increase. So in other words, the market hasn't figured out how much profit increase has happened to the gold miners. The profit is up 3.6 times because of that increase in the gold price, because you got the cost factor on the underside. And yet all we've got is maybe at the most 2 times, probably 1.5 to 2 times. And it's happened so recently that the market hasn't figured it out yet. But that tells us that, you know, if you want to make some serious money, people, invest in the gold miners, because the market hasn't even figured out what their profits already are. And when they do, then you're going to see it go up, and then the multiples are going to start looking like the multiples on Agnico Eagle and Alamos and so forth. So now let's go. I don't know how much more I want to say about that. You can see from the charts what we've got there and what's happened. Let's go to the gold miners analysis page, which is slide number 10. Okay. I've been, ever since the mining industry came out with the all-in sustaining costs, it's made it very convenient to calculate a gross margin, which is basically the difference between the price of gold and the all-in sustaining cost per ounce. And so, and then what I do to try to get a sense for what the market is doing in regard to that is basically take the market cap and divide it by the gross margin. And that's what you see on the far right side of the data sheet there. So then the first one I use is Alamos, because it's a really, really good company. The market loves it. And it's basically an indicator for where, if you're doing all the right things and you have good profits, what is the multiple going to be? And it's right around 10 for its current expectation of profit. And then when you get a little further out, then it becomes 9. And so I have 2 numbers in the gross margin, one for the more recent and then the other one for the future multiple based on where the production is going to go. And these companies that I own, I don't own Alamos at the moment, but it's a great company. But I own the ones that I do because if you look at the right side, you'll see that in future the multiple is going to be much, much higher. If it's going to go to 9, then you're looking at multiples out there of Rio 2 is 2.0, Eris is 1.5, 2.6 for Calibre, K92 is 2.5, G Mining 2.5, and the only ones that are out there very far are the top two, G Mining in particular, but K92 is actually I don't have a column there for 2025 because it's being rated at only 3.4 at the moment, and when it gets to 300, then it's going to go up quite a lot. So I unfortunately didn't have enough another column for 2025 to show. So K92 is going to be re-rated in 2026. So, and most of these are. Rio 2 will basically be starting production in 26, but not fully until 2027, but a really, really good company. And the others are all going to have re-ratings because of production increases, whereas Alamos and Agnico Eagle and Kinross are going to benefit from the increase in the gold price and an increase in the multiple that the market gives the mining shares once they get excited about them. But they don't have the growth potential that potentially is going to grow down the road by 3 or 4 times. If it goes from 2.5 up to 9 and 10, and they don't have that. And that's why I like these, because these companies are good companies. They make a profit. They don't have the uncertainties about permitting and financing and all the other stuff that the explorers and developers do. So the risk factor is way, way less than that. The other thing, and just curiously, I like G Mining for another reason too. Even though their production is out into the 2028 period, and I normally don't get quite so excited about something that far out, but that company is relatively new. The market loves it, and they love it because the people who founded it and manage it is a French family. G is Gagne or something like that, whatever. But that business of G Mining, that they were in the business of engineering and building mines. They build them for Lundin and all sorts of people. They've been doing this for decades. So the confidence that the market has in those people is off the charts because they've been doing it for a living. Building, they just decided we're going to have a gold bull market. We ought to have our own mine. And so they did. So what I expect is going to happen with them is that somewhere in the 2027, 26, 27, they're going to acquire somebody else. And we're going to start to see a lot of merger and acquisition activity in this sector because for the long bear market period that we had, the gold miners were laying off geologists and cutting expenses because the gold price was so low they couldn't make any money. So they were high grading the deposit, all this kind of stuff. So their inventory of gold in the ground now is relatively low because they used it up and didn't develop any new. Now they're in a bull market, but it's going to take 10 or 15 years to start a new one from scratch. Yeah. So what are they going to do? They're going to buy the ones that are in development or in exploration now. So the juniors will do well, and people who buy the right ones will do well. But I'm not interested in those because I haven't had much luck with them over the years. I seem to not buy ones that have the greatest story in the world, but it doesn't turn out well. And part of it is the fact that they may end up building a mine, but they dilute you to oblivion before the time they get there. And it takes all the time that it takes to permit and finance and blah, blah, explore. And so anyway, But there's a lot of people that like them, and most of your guests are all telling their subscribers about the latest 20 bagger that's about there. But that's not my thing, so I'm not going to tell people about that. But I like the producers who are underneath their umbrella, developer stories that will produce major increases in their production and profits without the risks of the developers and explorers. So that's how I like to do it. Okay, I think that pretty much covers that. Is that pretty clear of how my methodology with this? And the thing about it, I just want to point out to people, anybody can do this. It's very easy. I mean, every mining company has a good website. You go there, click on the corporate presentation, and you will very quickly find their forecasts of production and their forecasts of all-in sustaining costs. That's all you need to know. And then I assume, as you can see down below here, a gold price of $3,000 an ounce, and to do the calculations. But even at that, the gold price was already 31.57, and yeah. Well, let's talk about silver a little bit then.
Yes, would love to hear about silver. Usually we spend a lot of time on gold, but let's look at what's going on with silver.
Yes, I have a slide for that where I plotted the silver price in relation to gold. Obviously, silver goes up with gold. And that you can see that from the chart. And in 1980, it was way, way up in relation to gold. That happened again in 2011, 12. And now it's crawling along, and it's not keeping up with gold up to now. Will it in the future? A lot of people are believing that the gold silver ratio, being that it's now over 100, and that in these peak periods here was down around 40, that the silver price should be $100 an ounce. I don't know about that because there is some significant differences. One of which is that the big impetus for the gold price has been central bank buying. Central banks don't buy silver.
Sadly, no.
So you don't have that tailwind behind silver. It's not there. And so what extent is that going to matter? I don't know, but it's certainly an issue. The other thing is that all the silver that comes into market, 70% of it is as a byproduct of something else, not from a so-called silver mine. And actually, there's only one really true silver mine in the world, and that's Aya Gold and Silver, which I don't own at the moment because the market's fully valued it. Its revenue is 100% silver. All the others are in the maybe 65% silver, and many of them, Pan American and First Majestic, whatever, are actually even below 50% silver. The rest is lead and zinc and copper, and I'm not excited about that. I do own some silver, a producer and big developers. I like Abra Silver and Vizsla Silver particularly. And the reason I like them is they aren't 100% silver. Oh, but what's the byproduct? It's gold. And I like that a lot. So, and Endeavor Silver is a producer that I like also because their byproduct is gold. And so I'm thinking, okay, if I can buy a silver company and look at that, but they also have gold, I think pretty hard for that one not to make out because of all the momentum that's there. And the other aspect of the byproduct issue is that the world is electrifying. We know that, right?
Yes.
And what do they need to electrify? Well, they need some silver, but primarily it's copper.
Absolutely.
And what I think happened with the gold silver ratio back in 1800s, you had the gold silver ratio was like 16, right? Mm-hmm. Well, then, and we got into the 20th century and it went up and it stayed up. Well, guess what happened? When the world electrified, the amount of copper produced went way, way up. Well, that also produced a huge quantity of byproduct silver. So the supply side on silver grew way up. And so the gold silver ratio, it never came back down to 16 again. And what I'm concerned about this time is we're continuing to electrify now with renewables and electric vehicles, and that sort of stuff. So you're going to see a huge increase in copper production, and which means there's going to be a big increase in silver production that's basically indifferent to the price of silver. And that will, again, cause the supply of silver to grow maybe a lot. So I'm a little bit skeptical at this point, given those two factors, as to where silver is going to go. It could boom right up, and certainly it's called a poor man's gold. When gold gets to be super expensive, a lot of the ordinary folks can't afford an ounce of gold, but they can afford some silver. And you generally see the silver price go up late in the bull market for gold, because that's when the general public gets in, because they on poor souls obviously get in late. That's typical of them in both stock market and gold market. They get in, and their brother-in-law's in it, so they're going to get some, and they buy silver at that point. And then it goes, then when they lose interest, then it collapses back down again. And that's been the pattern in the silver market. If you can see on this chart, it goes way up and then comes down dramatically. And so that's a pattern where if you're going to be in silver, if it goes up like that, you want to sell some, maybe a whole lot, because the market is small and so it's very volatile. Whereas a gold, I don't even advocate selling gold bullion. I'm going to keep mine and give it to my ancestors and not my ancestors, my children and grandchildren and so on. Got that backwards. So anyhow, that's pretty much what I have to say about silver. And then I had a few comments about the state of the economy and so forth, and when to talk about the tariffs and globalization and all that.
Yeah, I think that's a great idea.
One of the things that I learned recently, one of the podcasts that I follow is called Macro Voices, and also another one is Thoughtful Money, and Macro Voices had on a man named Luke Groman. Are you familiar with him? He's a money manager, and he's a very brilliant guy. And I always learn things from him. So what I'm going to share is his work, not my original. And what he told us in the podcast was that Trump is totally serious, that his primary objective in this administration, this 4 years, is to basically eliminate income tax on the bottom 80% of income earners in the U.S. And he wants to replace that revenue with tariff revenue. And the thing that was interesting about Groman is that he basically put numbers to that. And he said, okay, if you eliminate the tax revenue from the bottom 80%, the upper 20% pays most of it. And the number he said is like $700 billion a year comes from the bottom 80% or 20. Yes, the bottom 80, excuse me.
Okay.
And if you have tariffs, it's very possible you could get 700 billion in revenue out of tariffs, and then it would work. And that he and his people have crunched the numbers, and that's what he wants to do. And I can see a lot of reasons. He's basically campaigned on the middle class, working class, giving them a break because their standard of living has gone down dramatically, and the upper 10-20% has gotten very, very rich on their appreciation of real estate and stocks because of all the government policies and what have you. And so that's it. And if you do that, that 80%, that's a lot of votes. And so that could solidify his program over the longer term. And that's his game plan. Now, that also means he's not going to use that tariff revenue to reduce the budget deficit.
Right.
He's not going to do that. And the thing to realize about the budget deficit is that there's no way it's going to go down at all, because, and the primary reason is demographics. We have an aging population, and where the greater and greater percentage of people are over 65. So what that means is that the working age population is declining. You can't grow GDP with a declining population. GDP is determined by the number of hours worked and how productive those hours are. And so you've got a huge headwind as far as GDP growing when you have this circumstance. This is true in all the developed countries in the world. Japan and Korea and China are probably worse, because their birth rate is, way, way down there. We're like close to 1, and you need 2.1 just to replace. So, but in the US, we're well under the 2.1. So that's going to be really difficult to grow the economy, to have more revenue, to pay more bills. So you're not going to reduce the budget deficit that way. And then, of course, that also means when you have an aging population, that Social Security goes up, Medicare goes up, and you're not going to see interest rates go up down much, because of all that's going on, particularly with tariffs. You're going to have more price increases, and Trump wants to have the working class get better wages, and so you're not going to end up with lower interest rates. It's going to be probably higher, and anyway, in the long run, over the I don't know how many decades, the average interest rate, I think it was from like 1970 to 2000, the average interest rate on the 10-year treasury was 5.75 average. So in other words, the kind of interest rates we've seen here in the last 20 years is an aberration. It's not normal. And we're going to go back to what was normal. And that means the interest expense is going to go up. And then there's defense spending. We got a whole lot of geopolitical problems, what they are, and that's going to cause both the Europeans and the Japanese and us and everybody else to spend a lot more money on defense. So we're going to have more budget deficits. The debt's going to grow, and the money supply is probably going to grow more, because that's what quantitative easing is. That's what happened in the COVID years, and that's going to be bullish for gold. So there you got another one.
Yeah, there you go. Everything really is coming back around for gold, and
Everything. So
really interesting.
I just hope that our audience, if you're not involved in the gold market now, this is the time. This is the time, and because the general population and the investor group, they're still buying stocks. There's the smart money, though, is not. I mean, Buffett is sold out a lot. And if you look at the put call ratio, you know what that's about. And the fact that all the management and insiders in corporations are by law required to indicate when they buy or sell stock. And they're selling 10 times more than they're buying. What does that tell you?
Yeah, that should send you a pretty clear message.
Isn't that obvious that what the smart money's doing? But the CEOs are still buying buybacks, because that goofs up their share price and keeps their bonus. And that's all they give a damn about. So, but the timing for everybody in the audience, if you aren't already in the gold market, please take a serious look. And what the research that I've done, all that information is available to you from the internet and corporate presentations on websites, everything. So it's not that hard for you to spend some time and learn yourself that this is never going to be a better time to get in the gold market. It can't get any better. Everything, every factor is lined up to help you.
Wow, very, very strong message, I think, to end on for everybody. So I hope everyone's been paying attention to
Yes.
this interview, to the previous interviews. This was really great as usual. So thank you so much.
Oh, my pleasure, as always.
Okay, well,
Thank
we'll
you.
wrap it up here for now, and we'll hope to have you back again soon to go over any further developments in gold as well as silver and the mining stocks.
Oh, I'd love to. I always enjoy it.
Okay, well, very good. Once again, I'm Charlotte McLeod with investingnews.com, and this is Don Hansen.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.